All right, so we're back again for another session. It's been a little while, Sam, so I've been sitting here with you for a podcast.
Yeah, it's been a minute, and it's good to have you back on. It's good to be back on. It's been a bit of a break, so hopefully everyone's been waiting, hanging out for another edition.
That's it. What's been happening in the markets?
Mm-hmm. Yep, absolutely. It's been a volatile period. I'm sure people are asking lots of questions, deep in thought, scratching their heads, and hopefully we can provide some little insight from our perspective, and hopefully you guys find it useful. If you do, or even if you don't, consider hitting the like button, consider subscribing, and it would really help us out a lot.
Leave a comment, ask some questions, let us know what you want us to talk about in future sessions. That'd be great as well.
Fantastic.
So some of you might be scratching your heads about what's been happening in the market. You know, we had a good couple of months up until the CPI reading this week on the markets. So markets going up and up and up, and tumbling back down again.
Yeah, absolutely. And I really do think that the market had really started to price in a bit of a pivot on central bank policy. And they got a rude awakening when inflation CPI, I should say, was pretty sticky, particularly core CPI. So prices, after removing volatile items like food and fuel, were growing strongly. Those baseline, everyday core prices growing strongly.
That's it. So leading up into that reading, I think a lot of people were expecting things to turn back around the other way, weren't they? Right.
There's a
lot of chatter out there that inflation was going to come down, and we've seen the top and everything else. But as Sam just said there, the core CPI, if that's going up, then you sort of got to start thinking, okay, well, maybe inflation's entrenched in the system for a while. You got wage growth, you got companies lifting prices, doing what they need to do to keep their profits up. Is increasing interest rates really going to stop that in the short term?
No, and I've been saying this to a lot of the guys in the office, a lot of our clients. In the short term, interest rate rises push inflation higher. You've got landlords who've got increased mortgage costs. Well, what do? They raise their rents to help pay for their mortgage costs. You've got businesses, their costs are increased through borrowing costs. What do? They raise their prices to try and maintain a profit. And as long as they're able to, higher costs will lead to higher prices, just an inevitability. And, higher borrowing costs are no different. So in the short term, these interest rate rises, I think, are continuing to push prices higher.
Correct. And I 100% agree with that. So I guess where my head goes is what's next, right? Mm-hmm. So what's next for the world economy? What's next for companies? What do they need to do to survive in what could be a hard landing for economies? Yeah,
I think it's getting to the point where a significant amount of economic damage will need to be done to bring prices back down.
Yeah.
A hard landing, I think, is not inevitable, but I think we're going to avoid the soft landing. I think we will see another US recession, and probably European recessions if they're not already.
I'll put it another way. I think a hard landing is more likely than a soft landing at this point.
Yeah.
Right, where before it was kind of, for me, it was 50-50. Now, seeing that last CPI reading, knowing the Fed's going to go another 75 points next week, maybe even a full percentage point. Mm-hmm. How do we, for me, it's much more likely the US economy, the European economies are going to go for a hard landing.
Yep, absolutely.
We're a bit more protected here, I think. We've got a strong export market. There's high demand for our product. I think Australia will probably avoid that hard landing, but our market will follow overseas markets slower.
Yep, no, for sure. I think another thing that protects us, and it's not necessarily a good thing, but our banking oligopoly.
Oh yeah.
The big four basically controlling the borrowing and lending markets here in Australia, are much more able to pace out the economic pain due to increased borrowing costs or housing defaults or things like that. So I think that'll help us as well.
So bringing it back to the US market for a second, there's a few alarm bells now going off for me, right? One alarm bell is obviously we're seeing the US, the bond markets yields are rallying again. Mm-hmm. Okay, so expectations for the Fed rates now up above 4%. So it's still a long way to go. I thought the markets were coming in to meet at one stage about a couple of months ago, where the bond markets were not far off the Fed. Now it's ballooned out again. So it means that the next few months we can expect huge rate hikes. The other part that's worrying me is the commentary coming from a lot of the large US companies. And we're starting to see them move more towards, cutting staff, cutting costs, and that's never a good thing, right? So I think markets have held up because employment numbers have been good, other economic data has been good. But if you start getting too many companies going into cost-cutting mode, well, what does that mean for economic data in the next 6 months?
I think it's, as you're sort of alluding to, a very, very strong forward indicator. Absolutely.
So look, I've got some numbers on this. Reading a few different articles around the internet today. Forbes is expecting 51% of US companies to start laying off staff. Some have already started. So Microsoft have already laid off 2,000 people. That's 2.7% of their workforce. Apple's laid off about 100 people. Shopify, 1,000. Robinhood, 700 people. Netflix, 300 people. Just to name a few. There's more on the list, but I won't name them all off, right? But this is already starting to happen, and this is what I think for us, as investors, we've got to keep an eye on. If companies continue to lay off staff, then what does that mean for the US employment, right? What does that mean for their economy? And that's your definition of the hard landing, isn't it? Okay.
Yep.
People start losing their jobs. They can't pay for their mortgages. They stop spending, and it's just that flow on effect.
Yep, absolutely. And this is my point. Sort of getting to earlier is that, in the short term, interest rate rises might increase inflation, but at a certain point, you hit that inflection where prices can't go any further, and everyone foresees a big economic crash, and then that's when interest rate rises can bring down inflation, is when sufficient economic damage is occurring.
Correct.
And I think you're raising a great point that damage is on the horizon.
So look, it's always a balancing act, guys. Nothing's ever set in stone, right? We know that. Not saying the markets are going to definitely crash from here further, but I can tell you the risks are mounting for me. As the months roll on, I'm becoming more and more bearish in the short term.
Yep.
Longer term, I think there's definitely some positive things to be talking about in mining and in green energy. And there's so many positive things I can say longer term. But shorter term, I think we've got to have a bit more of an actual official US recession. And that's a recession that has to happen now, I think, to bring that inflation down. So what does that actually mean for markets in that recession? Yep,
absolutely. And you're hearing some conflicting views out there. I think Ray Dalio came out this week and said, 20% lower for share prices ahead of a first half 2023 recession. There were dissenting views, though. I think Cathie Wood's basically saying this is the dip, and we're going long tech here. But traditionally markets bottom out as the sort of recession starts, which might indicate right towards the end of the year. That's still potentially 3 months more selling.
Correct. For me, I think as long as there is pressure on the interest rates going up, the market's going to keep either falling or going sideways at these current lows, one of the two. And we know next week is going to be a rate hike. You can almost guarantee early November is going to be a rate hike. Just don't know how severe that rate hike is going to be at this point. So for me, at least the next 2 months, towards middle of November, I think the market's going to whip around, right? Like you're going to have upward movement. But I think we're going to stay in either a downtrend or a sideways trend at the bottom here.
Yeah, absolutely. And I think, as you're saying, maybe 75 basis points next week, maybe another 75 in November, very early November. That puts them at 3.75 to 4%. That's sort of roughly where bond markets are thinking it might top out.
Yep.
And also, that's going into potentially the first really bad quarters of Q1 2023, Q2 2023. Yep. Could, the end of this year be the potential inflection point for markets?
Yep. I think it could be. We've seen some speculation in between Fed announcements. Have you noticed it?
Yeah, yep.
So you get the Fed announcement or the CPI announcement, one of the two, one in the same, in my view, right? Whether it's CPI or Fed, because CPI is leading what the Fed's doing, right? So you get these readings, the market dumps down, and then you don't get a reading for a while, the market wants to go up and up and up. And because there was such a big period of time between the July and the September reading, there's a good period of time where the market just ticked up and up and up and up
absolutely.
and up, right?
And I think also the July CPI was perhaps a little better than expected, and that sort of added to that optimism that we've seen the peak here.
That's right. So what could happen this time as well is after next week, because reporting season's mid-October, you could start seeing another rally into that sort of mid-October, sort of late October period, and then all of a sudden people start focusing on the CPI and the Fed again towards the end of October, coming into November. So just putting it out there, the market could be a bit bearish for a few more weeks, have a little rally, and then let's see where the sentiment is after that.
Yep, absolutely.
So that's kind of where my head's at the moment.
Yeah, I think so as well. I think you've called it pretty correctly. There's economic storms on the horizon. Markets often sell into those storms and then, can stabilize during the storm and then, eventually come out into sunshine. And, that's probably another episode, but there are things to be optimistic about as well.
There is. And guys, you gotta understand that, even in these types of markets, it's not great for investors, right? There is a couple of stocks out there that have been doing really well, right? Go look at BXB on our market, go look at CPU. There's always bullish stocks inside a bearish market, right? But this is where trading really shines, right? This is where the shorter term trading that we do with options and things like that are really fun in this type of market. And the whippiness is actually exactly what you want as a trader.
Yep.
There's nothing worse than trading a really dead sideways market that moves in a 1% band for a couple of months. You want this 2, 3, 4, 5, 6% movement in a week as a trader. It's actually can be really good.
Yeah, absolutely. I mean, if you want to see what's involved, we'll put a link to our free mini course down below, completely free. And hopefully you like that as well.
Me and Cara did a webcast the other night on trading, so you see that on the YouTube channel as well. Go over and have a look. But that's pretty much what I wanted to cover today.
Look, I think you've pretty much hit the nail on the head. We're going to open up for another big drop on open. We've got a few positions to look at, so
might
get back to it.
Thanks for listening in.
Thanks, guys. Bye for now.
Bye for now.